Welcome back to the Equity Trust Virtual Classroom. I'm John Bowens, and in this episode, I'm going to talk about the 3 strategies that I've learned working with high net worth individuals, ultra high net worth individuals, and family offices over the last 15 years. Now, these are strategies that the everyday investor, just like you and I, can adopt as well. As always, in this episode, we'll answer one of our viewers' questions at the very end. Make sure you drop your questions and comments in the comments box. And if you haven't done already, make sure to subscribe and hit the little bell icon. That way we can alert you to all of our upcoming videos. The first strategy to introduce you to is investing in the private markets, inside and potentially outside of a retirement savings vehicle. Now, when we talk about the private markets, also known as alternative investments, we're speaking to investments that go beyond the traditional stock market. So investments in privately held companies, investments in real estate. That could be an individual rental property, or it could be a multifamily real estate type syndication. It could be real estate joint ventures. It could be private money lending, mortgage notes, trust deeds. Beyond real estate, investing in privately held companies, private equity funds, investments in private debt funds, even gold and silver, physical gold and silver, or digital assets like cryptocurrency. According to Statista.com, you can see here that in 2022, they're reporting out that looking at high net worth individuals, they had 26% of their portfolios invested in the private markets, invested in alternative assets. Now, high net worth individuals, that would be individuals that are between about the $1 million to $30 million range. Then when we look at ultra high net worth individuals, you can see here that would be 30 million and up. They have about 50% of their portfolio allocation into private market investments. Now, you might be thinking, how do I gain access to private market investment opportunities with my self-directed retirement savings account? Well, number one is having a self-directed IRA with the right custodian that will allow you to invest in the private markets. Secondarily, if you're somebody that says, I'm not sure exactly where to identify private market investments, there are plenty of resources and tools that you can gain access to. Now, with online platforms, you can easily, the everyday investor like you and I, can gain access to private market investment opportunities. In fact, we've built an entire system here called Wealth Bridge that allows you as an equity trust self-directed IRA investor, all digitally within your account, to be able to connect into a private market investment platform where you can browse and click and invest in a very seamless process. So the everyday investor now has access to the private market investment opportunities that at one time were only reserved for the high net worth individuals and ultra high net worth individuals. Strategy number 2 is utilizing tax efficient retirement accounts and non-retirement accounts to invest in these various private market investments. So the Roth IRA is the first account type that comes to mind for a lot of individuals that are looking to create tax-free profit and take tax-free withdrawals. But there are other accounts as well, such as some business retirement plans that offer an after-tax Roth component that we'll talk about, and then also the health savings account and the Coverdell education savings account. So first, let's start with the Roth IRA. The Roth IRA is funded with after-tax money. It grows tax-free. When you take the money out after the qualified retirement age of 59 and a half, or leave it to your children or grandchildren, it's a tax-free account, providing that you follow all of the other rules and guidelines. Now, prior to 2010, many Americans did not qualify for a Roth IRA because they made too much money and they couldn't contribute to a Roth IRA, or they couldn't contribute to a traditional and then convert to a Roth. But see, the law changed in 2010 that allows all Americans, regardless of your income, to convert tax-deferred money into a Roth IRA. And I had the opportunity to observe hundreds of thousands of high net worth individuals convert funds from their traditional tax-deferred accounts into their Roth accounts. See, the logic for many individuals in this instance was that they would pay more in taxes on the much larger crop than on the smaller seed. So instead, what they did is they converted money. They generated growth and profitability in those accounts, all of which was tax-free. And then when they take money out or they leave it to their children or grandchildren, it's tax-free to them in their retirement years or leaving it to their children or grandchildren. So the question that you'll have to ask yourself is, would you pay more in taxes on the seed or on the crop? Now, we couldn't tell you here at Equity Trust whether you should or shouldn't. We'd encourage you to speak with your CPA or tax accountant and crunch the numbers and determine what's most prudent for you. But the idea is converting from tax deferred to a Roth account. So for example, let's say you converted $100,000 from your traditional to your Roth. You would pay taxes on that $100,000 based on your ordinary income tax rate. So that amount of $100,000 in that example would be added to your ordinary income, and then you would pay taxes accordingly. So let's say your effective tax rate all in is 20%. So 20% of $100,000 is $20,000. So you convert the entire $100,000 and you pay $20,000 in taxes. So that's what's known as a Roth conversion. Now, oftentimes I have the question, do I have to convert my entire traditional account to a Roth? The answer is absolutely no. You can convert in stages. So you can convert money over multiple years in order to spread out your tax burden. Again, check with your CPA or tax accountant so you can start crunching the numbers and determine what's most prudent for you. All right, that takes us to the business retirement plans that have a Roth component. So the first account type that comes to the mind of many investors is a solo 401k. See, as a self-employed individual, providing that you have enough earned income, you could potentially contribute up to $66,000 to a solo 401k when you're under the age of 50. When you're 50 and over, you could potentially contribute up to $73,500. Now, you do have to have enough earned income. You have to meet other qualifications. We have other video training on that. But if you're somebody that is a self-employed individual, you're a high income earner, you're a high net worth individual, you can look at one of these solo 401ks as a way to get more money into a Roth environment. And yes, there is a mechanism to actually have that entire $66,000 or $73,500 in the Roth component of the solo 401k. Secondarily, there are a couple other business retirement plans, especially for some of you that might have employees. There's a SEP IRA and there's a simple IRA. And with a recent law change, these accounts now allow for an after-tax contribution, call it a Roth contribution. For example, with a SEP IRA as a self-employed individual, providing you have enough income, you can actually contribute up to $66,000 to a SEP IRA in the year 2023. Now, generally, that's a tax-deductible contribution, but under these new law changes, the Secure Act 2.0, you are now permitted to make an after-tax contribution to that SEP known as a Roth component. All right, last but not least, you have the Health Savings Account and the Coverdell Education Savings Account. So who knew that you could actually self-direct an HSA, a health savings account, into private market investments? I've seen clients own real estate in their HSA accounts. I've seen clients partner their HSAs with their other accounts to make private money loans. I've seen clients do real estate options with HSAs. I had a client that invested in a real estate syndication, a multifamily building, with their health savings account. And the growth is tax-free. And when you take money out of the HSA to pay for qualified healthcare related expenses, your distributions as well are tax-free. And then the last tax-free growth-oriented account is the Coverdell Education Savings Account. So in 2023, you can contribute $2,000 to any child under the age of 18. You open the HSA, you make the contribution, it's after tax. It grows tax-free just like a Roth IRA, and you can invest with the Coverdell Education Savings Account into private market investments just like self-directed IRAs. For example, I had a client that is in the land flipping business. So he buys land, sells it for a profit. And he had 3 children, 3 boys. And he partnered all 3 of their Coverdell Education Savings accounts to buy a piece of land for about $8,000. And he had CESA number 1 with $4,000, CESA number 2 with about $2,000, and CESA number 3 with about $2,000. So it was a total of an $8,000 purchase, $4,000, $2,000, and $2,000, partnering the 3 Coverdell accounts together. And then he subsequently sold that lot for about $60,000 to a builder. And he made a $50,000 net profit. So that net profit was split across those 3 Coverdell Education Savings accounts. 50% into the oldest child's covered L account, and then 25% of the profit to child number 2 and 25% of the profit to child number 3. So when it was all said and done, he made $50,000 in tax-free profit. He paid 0% tax, and now he's able to use that money. He's able to draw from those accounts and pay for his children's private school tuition, and then eventually he'll be able to use it for their college tuition, all tax-free. So in conclusion here, before we move on to strategy number 3, you can think about utilizing these tax-free growth-oriented accounts. Even if you're a high-income earner, you can look at a backdoor Roth approach where you contribute to a traditional IRA or take existing tax-deferred money and convert it into a Roth IRA. Strategy number 3 is partnering multiple tax-advantaged or non-tax advantaged accounts together to invest in private market investments. So what I've learned from high net worth individuals is they oftentimes make investing a family affair, and they also have financial friends that they partner with. So just to give you a couple examples, and I mentioned just a moment ago the gentleman who partnered his 3 children's covered education savings accounts, as well as an investor that used their HSA partnering with their other accounts. So you can partner your various tax-advantaged investment accounts together for singular investments. Now, you do have to make sure you follow the rules and guidelines. When you're investing with certain family members, you have to make sure that all profits and all expenses flows proportionally. So to give you one example that comes to mind, I had an investor, high net worth individual. He had 10 IRAs and investment accounts for himself and his various family members. He had traditional and Roth IRAs for him and his spouse. He had a solo 401k. He had an HSA. He had 2 children. He had covered education savings accounts and Roth IRAs for them. And he also had Roth IRAs for his in-laws. And what he did on one individual transaction is he partnered all 10 tax-advantaged investment accounts to make a loan to a mobile home park operator. So the loan that he made from all 10 accounts combined was secured by the property. And the borrower, the mobile home park operator, was paying back interest and principal payments to the combined 10 accounts. So each of those individual 10 accounts had their own individual ownership interest, which was proportionate with the capital contribution. So as payments flowed back into their equity trust accounts, those payments were split into each one of the respective accounts. We oftentimes see a husband and wife partnering their Roths or other accounts together to maybe buy a property. It could be a rental property, could be a multifamily real estate type syndication. And then in addition to that, also partnering with non-family members known as financial friends. In one of our previous programs, we shared with you 2 investors that partnered together to acquire a property, subsequently sell it, and they made each about $34,000 tax-free in their Roth accounts. So you want to be thinking about how you could potentially partner multiple accounts together, as well as how you could potentially partner with financial friends. All right, that concludes our 3 strategies. Now let's jump into one of our questions. Our question today is from Eric. He says, what's the best for self-employed filing a Schedule C besides a Roth IRA? And Eric mentions that he's in the service business. So this would go back to those business retirement plans. Eric, if you're a self-employed individual, you have Schedule C income, Schedule SE self-employment income, so you're paying Medicare and Social Security tax on the income, you could potentially look at either a solo 401k, which can potentially allow you to get you up to that $66,000 or $73,500 that we talked about, or you can potentially look at a SEP IRA or simple IRA. So there's about 3 different types of accounts that you can start to look into there. I'd encourage you to get with your CPA or tax accountant and also discuss that. But this should be a good starting point for you, the solo 401k, SEP IRA, or simple IRA. Great question, Eric. Make sure to drop your questions and comments in the comments box. Last but not least, if you're someone that is interested in learning more about some of the concepts that we talked about and much more, check out our Take Back Your Retirement Kit. In the comments box, we have a link. You can take advantage of this absolutely free kit that's going to teach you about how these various self-directed IRAs and tax advantage investment accounts can invest in the private markets, utilizing the 3 strategies that we talked about in today's program. Until the next one, as always, keep leveraging compounding interest in the absence of taxation.